Let's make this year your best real estate investing year ever by coming to the Real Estate Wealth Builders Conference. And the Real Estate Wealth Builders Conference is where you can join hundreds of real estate investors and over 40 plus expert investor speakers and learn how to have amazing success in your real estate investing business. The Real Estate Wealth Builders Conference is not like any other conference out there. This is a no sales pitch conference where the entire 3-day event is all about you and helping you meet expert investors, teaching you how to invest, and join a community of hundreds of like-minded real estate investors. And because you're part of the Master Passive Income podcast, I'm giving you 20% off your Rubicon Pass. That's right. Get 20% off your Rubicon Pass by using the promo code MPI20. MPI20. You need to be at the Real Estate Wealth Builders Conference. Join us in the heart of downtown St. Louis, April 10th through the 12th, 2025, for a transformative 3-day live event that's more than just a conference. It's a community of investors. Get your pass by going to rubicon.com, REWBCON.com, and use the promo code MPI20 and get 20% off of your Rubicon Pass. You're listening to the Master Passive Income Podcast Network. Welcome to the Master Passive Income Show. My name is Dustin Heiner, and I'm here to help you afford anything you want in life, create financial freedom and generational wealth by investing in real estate and creating passive income. And in today's show, we're going to be looking at what investors do to plan for a potential crash. We have no idea when the crash is going to come or when the correction is going to come, but we know eventually one will happen. This is what investors are doing and what you need to be doing as well. All right, let's start the show.
Welcome to the Master Passive Income Podcast, where we talk about investing in real estate with a special focus on making enough money so you can quit your job and live the dream life. And now, here is your host, Dustin Heiner.
What's up? What's up? Super blessed as always to have you here with me on the show. Now, I would say probably about once a year, I usually put out an episode talking about a recession or a correction or something going on in the real estate market or even the entire economy, calling for some sort of a crash or a correction. Now, a crash is a big word, meaning everything's going down, everything's really, really bad, and everybody's having a rough time. A correction is a little different. Correction is where prices have gone up tremendously and they come down and they stabilize at a much lower rate. Well, this episode, the reason why I have it is because I want you to prepare for whenever there is a crash, whenever there is a correction. I don't know when it's going to be. In fact, I thought back in 2018, actually, I was listening to people like Robert Kiyosaki, who's always calling for a crash. There's another guy named Harvey Dent. You probably heard an episode a long time ago where I talked about Harvey Dent back in 2017, 2018. They're contrarians, or they're always calling for crashes. In fact, I think Robert Kiyosaki, he's called like 18 of the last 2 recessions. You know, jokingly, like he's always, every year is another recession. Every year is another recession. Well, I know there will be another crash or correction eventually. Let's say it's 50 years from now. It could be a very, very long time from now. But you need to be ready as a real estate investor or investor in general, and as well as being able to protect your family. Because I remember back in 2008, 9, and 10, man, people were losing their jobs left and right. It was so very bad. If you were, working at the time, if you had a career, you probably saw, or you might have even felt yourself get laid off. In fact, in 2010 or 11, I got laid off because my job wasn't going very well and they didn't have the money and they said, hey, we don't have any money for you, so we're going to let you go, which was, it was an eye-opener. And the big reason why is because I've heard the saying, it's not if you ever lose your job or get fired or get laid off, it's when, because it will happen. I always shook it off saying, no way, I'm a fantastic employee, not to pat myself on the back. Like, I always got raises. My bosses always thought I did a great job. Everything's always great, but that doesn't matter. How good you are doesn't matter. It's honestly, it's all about if somebody's going to employ you. With that idea that when there's a crash, and when there's a crash, I'm not saying there's going to be one tomorrow, even this year, 2025 is when we're recording this. It could be 2026, 27. We have no idea, but we do know eventually something's going to happen. And it's much better when you're prepared for these types of things. And in preparing for a crash, there are a number of things that you need to prepare for. And I'm going to get into a lot of these things, like the idea that, somebody could easily think, okay, make sure you have cash on hand. Yes, I get it. Yeah, everybody knows you should have money. Like if you get laid off, you should have an emergency fund. Yeah, that's easy. So we'll get into a little bit of that. But things that you would not normally know is things like access to capital, connections, the business already built, things like this. And like I said, we're going to get into all this. But what you need to be aware of is that your position now could be so much better and capitalize when there is a correction. What I'm seeing with interest rates going up right now, you have the Federal Reserve saying we're only going to cut 2 times this, I think like 25 basis points, which is like a fraction. It's like very, very little. And the reason why mortgage rates have gone up is because Treasury notes have gone up. They are correlated, and also the Federal Reserve also, has some effect on it too. But with interest rates going up, prices must come down. Now, what's the reason why interest rates are going up? It's because the Federal Reserve, what they are seeing is that inflation is still going up. They haven't stopped it. In fact, 2020 to 2025 now, every year, it's probably been like 20% at the highest part, at least 10%, 15%, 20% might be a little high, but it feels like it. In total, 20% increase, if not 30 or 40%. Some things are 50% more than they were in 2020. And so when the Federal Reserve says, hey, we're going to try to keep inflation, it's at like 6% now or 3% or whatever, we're going to try to keep it between 2 and 3%. Well, that's future inflation. What's going to happen? What about all the inflation just happened? And so people have less money. Interest rates are going up. Prices are coming down. And here's a great thing. I've talked to you about this, the investor roadmap that we have at Master Passive Income. You start as a beginner, 0 to 5 properties. Your goal is to get to 5 properties as fast as possible. And we coach you in that, how to get to 5 properties as fast as possible. Then you become a business owner, a scaler investor, where you're scaling now from 6 to hopefully 20 properties. And your goal is financial freedom. The problems that come with that are stabilizing your income because you're growing so much and your money kind of fluctuates up and down. But once you become financially free because you stabilized all of your income coming in, then you become the investor, where the investor is now buying large assets, apartment complexes, hotels, and that's where you need to be. And obviously, Master Passive Income, we coach you every single step of the way, but you need to go from step 1 to step 2 to step 3. I went through it. My other friends who are good investors that are wealthy now, they're in the step 3, we've all done it. In fact, one of my students literally just now, he's having a rough time because he's having to stabilize. He's grown so fast, and then now he has to stabilize his properties, which takes time and it takes money, and it also takes a lot of work. When you get to this point where you're now stabilizing everything, becoming financially free, becoming an investor, where you now have more money than time, then you start investing in large apartment complexes. And this is what I was going to say. With interest rates going up, my goodness, I am so excited for what's coming. Like, even if there's no crash or correction or the economy doesn't go south and things start changing, well, I'll be completely honest and say I am so pumped that there are going to be amazing deals on small multifamily homes, like, 3-4 unit quads, triplexes, things like that, as well as apartment complexes. There are so many companies. There are syndicators that took money or got other people's money invested in a deal, buying a property, overpaid for a property, got bad loans. In fact, Brandon Turner, I've heard, I'm not saying it's for sure, but I've heard he stopped all distributions. And once you do that, eventually it seems like I see all syndicators, they start doing capital calls where they want more money out of you, even though you already invested one time. Well, what's happening now is these properties, big, large apartment complexes, are now coming for sale all over again because they can't refinance it. Their debt is so high, what they call the debt service, or how much money it costs to pay the debt, their loans, it's eating them alive, and they need to sell. Well, what's going to happen with us? We investors, and the reason I have this episode, we need to be ready for these things. We need to be ready with networking, with people around us, with the business already built, with people who want to invest with us, our own money. And that's also on top of why we have the Real Estate Wealth Builders Conference. I go to my own conference, the Real Estate Wealth Builders Conference, to get connected with amazing people. In fact, I found multiple investors in my deals, but going to my own event, I met one fantastic real estate investor. He's, like 9 figures. Really, really wealthy gentleman. And I said, hey, why don't we partner on an apartment complex? Once one comes up, let's partner. He said, yes, let's do it. I'm super pumped. He said, but here's the catch. I don't want to flip it. I don't want to sell it in 3 or 4 years. What I want to do is I then want to refinance it, pay off all of our investors. Let's say we raise $5 million. It's worth $30 million. We refinance it, pull the cash out, pay off our investors, and then we keep the property for ourselves and continually make money on it. I'm getting ahead of myself because this episode is exactly what you need to be doing as an investor, thinking like an investor so that if and when there ever is a crash, and honestly, even if there never ever is a crash, this is what you need to do to get to be a better investor. Come and hang out with me and 40 plus of my friends, expert speakers, as we're going to be teaching you all these secrets and tricks and tips that we've done so that you can do it as well. Use a promo code MPI Podcast and get 20% off of your pass. Go to rubcon.com, REWBCON.com, and get your pass. I kid you not, this is life-changing. I go every year. I put it on every year, but also I go because I grow so much. And with going to Rubicon, getting people around you, networking is one huge one. There are so many other things that I want to walk you through as you're getting ready as an investor for a potential crash, because you want to be able to capitalize when there are so many amazing deals out there in the market. Now, the first thing that you need to do to be prepared for this crash is to be investing for passive income. Now, passive income is basically where you don't work and you still make money. You buy one rental property and that one rental property makes you money. If you are investing for appreciation, where you buy a house and you hope that the value goes up over time, which we know eventually it will, but we also know that there's potential correction or a crash because prices are crazy, crazy high right now. If you buy for appreciation, I would be very concerned for you. In fact, I don't buy for appreciation. I'll give you an example. In 2006, when I first started investing, my first house I bought for appreciation. I lost my shirt because in 2010, I think I sold it for like $150,000 less than I bought it for. It was absolutely horrible. I learned my lesson there. And so the houses that I bought in 2007, 2008 that I bought for passive income, I literally still own, and they make me money every single day, every single month, every single year since I bought it and since the crash back in 2007, 2008, and 2009. So when you buy for passive income, making $250 or more in passive income, when you do that, you're protecting yourself. Even if the value goes down, the value meaning like you bought it here and the value goes down, it only matters if you sell it. If you sell it here, you lost that money. But if you wait and it goes back up, which all of my properties that I bought in 2007 and 2008 that were before the crash, I still own those. The values were here. They went down. Now they're right back up and above. So that's what is appreciation. You only want to go for passive income. Appreciation is great. And so what I love to do is I invest for properties that make me $250 or more in passive income. And I coach all my students that this is the criteria that you always want to have in your passive income is $250 or more. Now you might be thinking, oh my goodness, that's really, really hard to get. I'm like, yeah, it's hard to get, especially right now. Prices are high, but even now there are deals out there. One of my students just sent me a deal and said, hey, I got this deal. It's worth $130,000. I got it under contract for $70,000. It's going to take about $10,000 to fix up, but that's only $80,000. He's capturing, what is that, like $50,000 in equity, and it's like a $400 a month in passive income. It's a duplex. So these deals are out there as long as you're able to go after them. And I want to pause for a quick second and share that honestly, I really want you to invest in real estate. Now, my new goal is to help 1 million people invest in real estate. So 2 things I would ask from you. Number 1, if you get anything out of this episode, please share it with somebody else. Number 2, I want to get you to invest in real estate. Get my real estate investing course absolutely for free. Text the word rental, RENTAL, to 33777.
rental to 33777. I'll literally give you my course, show you how to find an area of the country to invest, how to build the business first. You know, I always talk about that, and how to find the right properties, how to make sure you're getting experts to do the work for you, and scale the business to where you're making $250 or more in passive income. Scale it up to quit your job. I'll literally get to you, or go to masterpassiveincome.com/free course. Obviously, it'll be in the description, but I really, really want you to invest in real estate, because the more that actual, normal, everyday people own real estate that are good landlords, the better everybody's life gets. The second thing that you must be doing right now and preparing for this housing market crash is to be investing all over the country. What I mean is, you do not want to be investing just in one spot. Now, I know if you only have one property, you're really only investing in one spot, but you want to be looking all over the country for new areas to invest in. And by what I mean by that is, if you are only looking in one city and just honing in on there, you're not going to see everything that's going around. There might be other cities that are doing much better or much worse. And if you're in the area, the city that's doing worse than the other ones, then you might have trouble. So what I do is I invest all over the country. And our students, my students for Master Passive Income, the coaching students, they invest all over the country as well. We have many different markets that we invest in. I'll give you an example of the reason why I'm saying being in different markets. If you're investing, and I know most people would not invest in San Francisco for passive income because you probably won't do it, but if you buy a house in San Francisco, you're probably going to pay $1 million. When there is a housing market crash or correction, it'll be cut in half. Like that house, and I literally saw this back in 2008. It went from like $1 million down to $500,000. That is $500,000 in equity just lost. And if you owe $1 million, more than likely these people that owe that $1 million and it's only worth $500,000, they're going to walk away from that property, and that's going to lead to foreclosures and so much. Go watch my crash video, my housing market crash video, where I talked about how it actually is going to play out, and that I talk about that. Now, when you are going to be investing all over the country, over in San Francisco, it's going to be crash in half. But if you're buying houses that are $80,000, it's not necessarily going to even crash in half. It might even crash like 20, 30, 40%. The houses that I bought in 2006, I was buying for much, much cheaper, like $40,000, $50,000. They only went down like $10,000 or $12,000, which is maybe like 20, 25%. So a house that is worth $1 million is going to crash much, much harder than a house that's worth $80,000. Now, the great thing is, because you might be thinking, oh, where are you going to find properties for $50,000, $40,000, $30,000? There are. Trust me, there are. And I'll show you exactly how to do that as well. And I actually buy these properties and make passive income, as well as get appreciation, even though that's appreciation is just icing on the cake. It's great. I don't count for it. Like, I don't say this is what I invest for. I invest for passive income. But what's great is if you're investing all over the country, you're seeing these different pockets of the city in a certain state, and then another city in a certain state, and another city in a certain state. You're seeing the housing trends, what they're renting for, what they're investing for, how much the purchase price is, all that sort of stuff. And at that rate, you can pick and choose where your great deals are. I personally have, I think, like 5 different markets that I'm currently investing in. And in these markets, I know what's going on in these cities. I know what properties are there. I know what my property managers are going to do. I know what properties are coming on. I know the trends because I see it come up and see it come down. So be investing all over the country, and not just knowing what's going on in the market, but you're going to make so much better money and see how your money goes further. You're going to buy a better property that makes you more passive income, and you're going to have less money coming out of your pocket. So be investing all over the country, not in just one area or even in just your one town. You can literally invest out of state, and I'll show you how to do this. Again, get my free course, masterpassiveincome.com/free course. I'll give that to you where I show you exactly how to do that as well. And the third thing that you need to be doing right now is start looking for 3 to 4 new markets to invest in, to understand, to analyze, to know. Because when you have a number of different markets, let's say you have a total of like 4 or 5 different markets, maybe 3 to 5 different markets that you are looking, like one in Indianapolis, Indiana, one in like South Carolina, one in Ohio, one in Florida. If you have these different areas, you're spread out all over the country, and you can see what is going on in each area. So I would like for you to see and find 3 to 4 different markets and really understand what's in those markets, the types of properties that are there. If they have predominantly 2-bathroom or 1-bathroom, like East Coast is predominantly 1-bathroom, not predominantly, but there are a lot more 1-bathroom homes because they're older homes and nobody really cared about having 2 bathrooms back then. So 1-bathroom, whereas on the West Coast, they're newer homes. So they're always 2-bathroom. Be looking at things like that, as well as understand the trend of how the housing market goes up and down, and see when it's coming down, and then see when it's starting to stabilize now. I see the prices getting down and they're starting to stabilize. And you're able to jump on it's like having a fishing hole. You have different markets, basically different fishing holes. 3 or 4 different fishing holes. Well, if one's not biting, well, then you go to the next fishing hole and you put your reel in there and it's not biting there. You go to the next one. Oh, I got one. So you have 3 or 4 different fishing holes. And that's what we're doing is we're building the business first. And that's a big thing. If you haven't watched any of my videos talking about building a business first, you definitely have to do that. Build the business first. So check in the description. I have all those links. I believe I should have all those links for all those videos. But you want to build the business first before you invest. But you have 3 to 4 different fishing holes to find great properties. Now, the fourth thing that you need to do is right now get a home equity line of credit on your personal residence. I know you might be thinking, oh no, it's my personal residence. Well, what a home equity line of credit is, it's you're locking in the ability to borrow money. Even if you're not borrowing money, it's like a credit card. You already have a credit card. The advance is on you, or like the credit is on you and your signature, whereas a home equity line of credit is on your house. Now, what happens is when you charge on a credit card, you actually put a balance. So you borrow money from the bank and put it on the credit card. From there, you pay it back. Same thing with a home equity line of credit. It's just like a credit card. As soon as you borrow money out of the property, out of the home equity line of credit, you get a balance. And then as soon as you pay it back, you don't pay any interest. You don't have any payments. It's not like a mortgage, like a full 30-year mortgage or anything like that. It's a home equity line of credit. You can dip into it and then pay it off. Dip into it and pay it off. And here's the big reason why you want to get a home equity line of credit. Back in 2009, after the crash, mortgages were they were so hard to get. In fact, one house that I bought in 2010, it literally took like 4 months for the mortgage company to go through. Now, how much better it would be if you actually had a line of credit? You actually had money to borrow that the bank has already said, I've already pre-approved you. Nothing's changed. It looks like we can still keep lending to you. What's great is once you have that home equity line of credit, it's much harder for the bank to say, no, you cannot spend any more on it, as opposed to going to a bank after the crash. Hey, bank, I'd like to get a home equity line of credit. Well, they just got punched in the face a bunch, like with foreclosures and losing money. They're going to be very gun shy, which means they're not going to want to give out loans very easily. You have to really, really be good and well qualified for these loans. So if you get this loan now or get pre-qualified and actually lock in a home equity line of credit with your property, you have like a credit card. You can then use that to go invest. If we already have the loan in place before the crash, we can utilize it after the crash and not have to go beg a bank to give us a loan after. Because what they say is, if you need a loan, they're most likely not going to give you a loan. If you don't need a loan, that's when they're saying, yes, I can give you a loan. It's a little sad, but that's just the way bankers are. They don't want to lose their money and they want to make money. And the fifth thing that you need to do is to secure a line of credit for yourself, a signature loan, not just a home equity line of credit, but if you go to your bank, whatever bank you're at, or if you go to a local regional bank where you are, maybe a credit union, get a signature loan now before the crash. Interest rates are very low. If you have a signature loan, you could basically pull out money so then you could buy rental properties. You're already having the money, the loan created there for you, as opposed to after the crash where the banks don't want to give out money. Just like with a home equity line of credit, you're getting the loan in advance for when you're going to invest. You know what's going to happen. Signature loan might be a little different in nuance because it's not like a home equity line of credit. They will literally give you that money right when you get it. But shoot, if you already have the business, if you're already buying properties, this is just money putting back into your business. Now, I will say as a caveat, you better be able to deploy that money and have your business ready so you can have that opportunity to then jump into a property with that money that you take out. Now, also, if you already have an ongoing relationship with a bank, the home equity line of credit, or with a signature loan, it's easier to get another loan in the future. So here's a trick. Here's a pro tip I'm going to give you. Now, this is super pro trick wise. Go to 2 different banks. If you go to the first bank and you get a signature loan for $1,000, you pull that $1,000 out. So you owe them $1,000. Then you go to that second bank Go to a second bank, get a signature loan for another $1,000. Well, what you do is you pull that $1,000 out, and then you pay off each other bank. That you basically don't pay any interest because you're paying the money back. Not saying that you actually have to switch it because it's still $1,000. $1,000 is $1,000, but you're paying it back. You might get a little bit of interest or fees or something like that, but once you pay it back, you develop credit rapport with them. Basically, they're saying, hey, I like this Dustin guy. He borrowed money and borrowed $1,000 and he paid us $15 or $20 to borrow it for a month. Shoot, let's go ahead and give him some more money. You're basically building up a rapport with a bank to help them to realize, hey, Dustin is, or if your name's Joe is a good person to lend money to because we're going to make money on him. We have a credit history, a credit rapport with them. So that is a great reason why you should start doing that now. Now, the seventh thing that you really need to do right now, because the value of homes are very, very high, what you want to do is sell. Now, it's hard for me to sell things because once I own them, they make me money. But this is what I want you to do. Sell underperforming properties. So if you have properties right now that are not doing very well, they're not making you very much passive income, you see, oh man, I made a little bit of money, appreciation's up. Sell it now. The reason why is because you'll capture in that high value. Once there is a crash, your value from here is going to literally come down and you're in a worse position. So if there's an underperforming property or a property that's just a headache for you, sell it now. Get rid of it now so you can capture that money to then put it into a better property. And the eighth thing that I want you to do is I want you to develop more banking relationships with other banks. Just like I told you how you want to go and get 2 signature loans. That's a pro tip I give you. 2 signature loans, pay off one, pay off the other, so you have that rapport. Do that with many banks because you never know if one bank, I have a great rapport with them, but then they literally shut down. Or, it's highly unlikely they'll shut down, but they literally shut down all their lending ability or something like that. Well, you have 2 or 3 or 4 other banks. So what you literally can do to build rapport is do that same pro tip where I gave you borrowing from a signature loan for $1,000 from 2 different banks. Do it to like 4 different banks and pay them back. You'll pay, $20, $30, $50 in interest or, fees or something like that. But that rapport that you have, that's 4 or 5 different banks that you have basically lines in the water for funding for your future properties. So you want to have banks, people who lend money. These are just regular people. Banks have people that work for them. That's what I mean. Banks have people that work for them. And so these are regular people. If you get to know them, they get to know you. They're like, man, Joe over here, he's a good guy. The bank makes a lot of money. I look good because I found this investor that is going to be borrowing money and paying us money. So get relationships with many other banks. The 9th thing that I really want you to do is to turn short-term properties, Airbnb properties, VRBO properties, into long-term properties right now. Because and we saw this through the pandemic of COVID-19, that people just stopped traveling. And when you do not travel, you do not make money in an Airbnb or a short-term property. Also, what's going to happen when economy stops, when the economy goes down, there's a housing market crash. When that happens as well, what's going to happen is people aren't going to want to travel as much. There's not going to be a lot of traveling and vacationing, which means your short-term rental property will be losing money because it's not being rented. Turn that into a long-term property because in the long-term properties, you're going to have them leased for a year. Basically, you're going to have somebody saying, I'm going to pay you for an entire year to stay in your property. And so my big suggestion is to turn short-term properties into long-term properties so you make constant passive income every single month, makes it a good property as opposed to a liability. It's an asset that puts money in your pocket as opposed to a liability because nobody's traveling. The short-term market's dried up. You're having to lower your prices. It's just not going to be good. So turn them into long-term properties. And the 10th thing that I want you to be doing right now to be creative, and I have more, so this is not the last one. The 10th thing that I want you to do is I want you to not pay off your mortgages early, especially the ones that have a very, very low interest rate. Let's say you refinance the house like 5 years ago. And maybe you got inheritance and you're like, shoot, I could pay off the house and have the house right now. I would not do that. And the reason why, if you got a low interest rate now, keep that. That's like an idea for the loan in the future. If you have cash right now, save that cash because Cash is going to be king in this housing market crash. When it does crash, your cash is going to go so much further. You're going to be saying, look at all these properties for sale. They're like, 10 cents to the dollar. So instead of like $1 million, they're selling for like, I don't know, $300,000, $400,000. Let's go and buy them. Well, I would not recommend buying $1 million house or one, but that was. But let's say a house was selling for $200,000. What might be cut in half? Let's say you could buy it for $100,000. Well, shoot, buy as many of those as you can. Save that mortgage that you have on your house now, because you're going to be able to look at that as already having a loan that has a great, great interest rate. If you pay it off, great, you'll have your house that is paid off, which is fantastic. Don't get me wrong, it's fantastic. But we're investors. We're looking for investing in the future. If we pay it off, that means our cash is gone. We are out of this loan we just had. Now we got to go through and get a whole brand new loan. Why not keep this loan? Keep your cash and then buy properties with the cash as a down payment, or buy it cash outright, whatever it might be. But don't pay off your loans early, because you could save that cash. And the 11th thing that I want you to do is create private financing opportunities, private money. Basically, you're going to be talking to your friends, your family members, acquaintances, business owners, anybody and everybody that you know. Now, don't be sleazy. Hey, I invest and I want you to give me money so I can buy properties. Don't do that. There's so many things that we need to talk about helping you to understand how to do private money. But one thing you want to do is develop relationships. Let other people know that you are actually an investor, that you buy for cash flow and passive income, and you're looking for other investors who want to invest their money in a loan. Now, you could do equity. I'm not a big fan of equity, because they have to have equity in the property, then you have to buy them out and everything. If you get them to give you a loan for money, that is so much better, because you can pay them off. You can even refinance the property, pull the cash out and give it to them and pay them off. So right now, you also want to be looking for private money lenders. You want to look for people that are actually going to be giving you money as a loan so that you can buy a property and make passive income for yourself. The more people that you tell that you're an investor, that you make money for other people, the more people are going to want to give you money. And especially if you show a track record. Hey, I had this property and I made this investor money. Or I have this property, it's making me $350 a month in passive income. This person you're talking to is like, wow, tell me more. Now, it's planting a little bit of seed in their brain that you're an investor, that they can make money through you, planting that seed. And then going back maybe, a month later. Hey, I have this deal. Would you possibly be interested? Or whatever it might be, as far as sharing with them what you're doing. But the trick is, or the key is, to share with them that you are doing it, getting it in their brain. Because who knows, maybe 6 months from now, they might be ready. Right now, they might not be ready. Most times, in fact, the people that I have got for private money, they are not ready. Right as soon as I'm telling them, they're not ready. Maybe they got to free up some money, liquidate it by selling stocks or whatever it might be, or they're just not ready mentally. They have too much work. But in 6 months from now, it might be the right perfect time. So that's exactly what you want to do. And that is it for today. Go ahead and get my free real estate investing course. Text the word rental to 33777, RENTAL to 33777. You can also join my Real Estate Wealth Builders group coaching. Get all my courses. All right, guys, we'll see you in the next show. See ya.